Let me ask you something right now, and I need you to really stop and think about this. Imagine waking up the morning after your 65th birthday, feeling proud, feeling relieved, thinking that Medicare is finally going to take care of you, and then getting a letter in the mail that tells you your Medicare premiums are going to cost you nearly double what your neighbor pays. Same coverage, same plan, nearly double the price, and the reason has nothing to do with your health, nothing to do with your age. It has everything to do with money you saved your entire life, money sitting in accounts that you thought were helping you, and the government is now using that money against you. That is not a hypothetical story. That is happening to thousands of Americans right now in 2026, and if you are approaching 65, it could happen to you too. But only if nobody warns you in time. So today, that is exactly what I am going to do. My name doesn't matter as much as what I'm about to tell you, because this information could save you tens of thousands of dollars over the course of your retirement. I've spent decades studying retirement planning, watching families make the same devastating mistakes over and over, and today I'm going to make sure you are not one of them. If you have a spouse, stop this video right now and go get them. Sit down together, because what I'm about to share affects both of you, and you need to hear this as a team. And if you find value in what I'm sharing today, and I promise you will, please take 2 seconds to hit that like button and subscribe to this channel, because we put out content every single week that is designed to protect your retirement, not just grow it. Now, before I tell you about the 3 assets you need to move before you turn 65, I need to explain something that most financial advisors either don't tell you or don't explain clearly enough. It's called IRMAA, the Income-Related Monthly Adjustment Amount. I know that sounds like government alphabet soup, and that's exactly what they want you to think. They don't want this to be easy to understand, but I'm going to break it down for you the way I'd explain it to my own grandchildren sitting at my kitchen table on a Sunday afternoon. Here is the truth. Medicare does not charge everyone the same premium. The standard Medicare Part B premium in 2026 is around $185 per month per person. But if your income, and I want you to hear this word very carefully, if your modified adjusted gross income from 2 years prior exceeds certain thresholds, Medicare charges you a surcharge on top of that standard premium. And those surcharges are enormous. We are talking about hundreds of extra dollars per month, per person, every single month, for the rest of your life in retirement. For a married couple, that can add up to over $6,000, $8,000, even $12,000 extra per year, every year, simply because of how your money is structured, not how much you actually spend or need. Now here is where it gets painful. And I mean genuinely painful, because I have seen this destroy retirement plans that took a lifetime to build. Medicare looks back 2 years. So when you turn 65 in 2026, Medicare is looking at your income from 2024. That means the window to protect yourself is right now, not next year, not when you get your Medicare card in the mail, right now, before you cross that threshold. I want to tell you about a man I'll call Richard. Richard was 64 years old, retired engineer, worked for 38 years, saved diligently, did everything right. He had a substantial traditional IRA, over $900,000, that he had been building his entire career. He had a brokerage account with dividend-paying stocks. And he had a pension that kicked in at 62. Richard thought he was set. His financial planner at the bank told him he was in great shape. What that financial planner never told Richard, and this is the part that makes my blood boil, is that when Richard turned 65, Medicare looked at all of that income, including his required minimum distributions from his IRA, and placed him in the highest IRMAA bracket. Richard went from expecting to pay $185 a month for Part B to paying over $628 a month per person. His wife was in the same bracket. Together, they were paying nearly $1,300 a month, over $15,000 a year, just in Medicare Part B premiums, before copays, before prescriptions, before anything else. Richard called his son crying. He said, "I did everything I was supposed to do, and somehow I'm being punished for it." That story breaks my heart every time I tell it. And I tell it because Richard is not alone. There are thousands of Richards out there right now, and you deserve better than that outcome. So let's talk about what you can actually do. Let's talk about the 3 categories of assets that, if restructured before you turn 65, can dramatically reduce or completely eliminate your IRMAA surcharges and protect your Medicare costs for the rest of your life. The first asset, and this is the big one, the one that blindsides more retirees than anything else, is your traditional IRA or traditional 401k. Here is the brutal reality. Every single dollar you pull out of a traditional IRA or 401k in retirement is counted as ordinary income. It doesn't matter that you already worked for it. It doesn't matter that it sat there for 30 years. The moment it hits your bank account, it counts as income, and Medicare sees it. More importantly, your required minimum distributions, the money the IRS forces you to take out starting at age 73, those distributions can single-handedly push you into a higher IRMAA bracket without you spending a single extra dollar. What you need to consider, and consider seriously, is a Roth conversion strategy. A Roth IRA, once properly funded, generates tax-free income in retirement. That income is not counted toward your IRMAA calculation. It is invisible to Medicare. Now, converting a traditional IRA to a Roth IRA is a taxable event. You do pay taxes in the year you convert, but if you do this strategically in the years before you turn 65, when your income may be lower, you can pay a much smaller tax rate today to protect yourself from enormous Medicare surcharges for the next 20 or 30 years. This is not a small deal. This is a fundamental restructuring of your retirement income, and it is one of the most powerful moves available to pre-retirees right now. Please, if you have a large traditional IRA and you are between the ages of 58 and 64, talk to a qualified retirement income specialist about a Roth conversion ladder before it is too late. And please, share this video with anyone you know in that age range, because this information is too important to keep to yourself. The second asset that needs your immediate attention is your taxable brokerage account, specifically the dividend income and capital gains that brokerage accounts generate every single year, whether you want them to or not. Many retirees don't realize that their brokerage accounts are quietly producing income in the background. Dividends get paid out. Funds automatically rebalance and generate capital gains distributions. And all of that income gets reported to the IRS, which means it gets picked up in your modified adjusted gross income, which means Medicare sees it and charges you accordingly. If you have a significant taxable brokerage account, there are strategies worth exploring: repositioning into more tax-efficient investments, using tax loss harvesting to offset gains, or carefully timing the sale of appreciated assets to stay below IRMAA thresholds. The key is intentionality. Your brokerage account should not be running on autopilot while you are approaching 65. Every dividend, every distribution, every capital gain needs to be looked at through the lens of how it affects your Medicare costs. This is the kind of planning that separates the retirees who thrive from the ones who struggle, and it is the kind of planning that most people simply never get told about. Now, before I get to the third asset, I want to pause for just a moment, because I know some of you watching this right now are already feeling a knot in your stomach. Maybe you're 63, maybe you're 64. Maybe you're sitting here realizing that you have a large IRA and a brokerage account and nobody has ever talked to you about IRMAA, and you're scared. I want you to take a breath. The fact that you are watching this video, the fact that you are paying attention right now, means you still have time to do something about it. You are not Richard. You are not going to be blindsided, but you need to act, and you need to act soon. So please leave a comment below right now. Just tell me your age and whether you have a traditional IRA, because I read those comments, and it helps me know what follow-up content to create specifically for people in your situation. Your comment matters. The third asset, and this one surprises people every single time I bring it up, is cash value life insurance, specifically whole life or universal life insurance policies with significant accumulated cash value. Here is the issue. When you take loans or withdrawals from certain types of life insurance policies in retirement, depending on how those distributions are structured, they can be treated as taxable income and can affect your IRMAA bracket. But here is the flip side, and this is where the opportunity lives. Properly structured life insurance, particularly certain indexed universal life policies designed specifically for retirement income, can actually be a source of tax-free retirement income that Medicare cannot see or count. The cash value grows tax-deferred, and when you take policy loans against that cash value, those loans are not considered income. Done correctly, this strategy can create a stream of retirement income that is completely invisible to Medicare's income calculations. Now, I am not telling you to go buy a life insurance policy tomorrow. What I am telling you is that if you have an existing life insurance policy with cash value, or if you are exploring ways to create additional retirement income streams that won't trigger IRMAA surcharges, This deserves a serious conversation with a retirement income specialist who understands how insurance, taxes, and Medicare interact. Most people never have that conversation. The ones who do often protect hundreds of thousands of dollars over the course of their retirement. I also want to give you one powerful warning before we wrap up, because there is a common mistake I see people make when they first learn about IRMAA, and it costs them dearly. They panic. They try to do everything at once. They do a massive Roth conversion in a single year, spike their income, trigger the highest IRMAA bracket, and end up paying more in taxes and Medicare surcharges than they saved. This is not a problem you solve in one dramatic move. This is a multi-year strategy. It requires planning, it requires projections, and it absolutely requires professional guidance from someone who specializes in retirement income planning. Not just investment management, but income planning specifically. If your current financial advisor has never mentioned IRMAA to you, that is a serious red flag, and you owe it to yourself to get a second opinion. Here is what I need you to do right now, today, before you close this video and go on with your life. First, look up your income from 2 years ago and understand what IRMAA bracket you might fall into when you turn 65. Second, open a conversation with a qualified retirement specialist about Roth conversions if you have a significant traditional IRA. Third, review your brokerage account and understand what passive income it is generating every year. And fourth, if you have life insurance with cash value, ask your agent to show you how distributions are taxed and whether your policy is optimized for retirement income. These are not complicated steps. They are uncomfortable steps because they require confronting something most people prefer to ignore. But I promise you, the discomfort of having these conversations now is nothing compared to the devastation of opening that Medicare bill at 65 and realizing it is too late to do anything about it. If this video helped you today, and I truly believe it has, please hit that like button right now. It takes 1 second, and it tells me that this kind of content is making a real difference in people's lives. Subscribe to this channel if you haven't already, because protecting your retirement is not a one-video job. It is an ongoing conversation, and I am committed to being here every single week to have it with you. Share this video with your spouse, with your siblings, with your friends who are approaching 65. You might be doing them the greatest financial favor of their lives. Because here's what I want you to remember above everything else I've shared today. You did not spend 30 or 40 years working, saving, and sacrificing so that the government could take it from you through Medicare surcharges that you never saw coming. You earned this retirement. You deserve to protect it. And the most powerful thing you can do right now, in this moment, is decide that you are going to be informed, you are going to be prepared, and you are going to take action before it is too late. The window is open. The question is whether you are going to walk through it. I believe you will. I'm rooting for you, and I'll see you in the next one.